Good morning, ladies and gentlemen. Thank you very much for joining us for the full year results for Delta Property Fund. I'd also like to welcome those on the webcast as well. We will allow for questions at the end, if there's any, and we'll also take questions from the audience if there is any. We were due to start at 10, so I'd like to stick to time, and we'll try and keep it going. I'm going to take you through the introduction and updates and the highlights. The SENS has been issued out early this morning, and for those of you that have managed to see it, I'm sure Chris has got a couple of pointers there, so you can perhaps ask a few questions if we can answer them now, or we can obviously take them up on the one-on-ones as most fund managers like to do. Chanel will take you guys through the financial review, and then Otis will take you through the portfolio review, which basically talks about our segments and where we're located, rate per square meters, our engagement with our biggest client being National Department of Public Works, and what we've basically been doing with the portfolio in the meantime. I'll then come back at the end to deal with the conclusion, and then we'll open up the floor for Q&A. Perhaps maybe just before I start, I think it's quite fair to say that for those of you that did join us for the half-year results, I was quite clear that I think it was in October, we were anticipating the ANC elective conference in December, and we did say to the market that certainly from a Delta perspective, we do anticipate quite a turbulent trading environment, even post 2019 elections, and I think going through the narrative at the moment, I think we are definitely online with that narrative. I think there's a lot of things up in the air. Certainly, we'll touch on to the long-awaited promulgation of the policy with DPW, the implementation of long-term leases that has been on the cards for quite some time. And obviously, all these things have got quite a big impact in terms of our business. Some of them are obviously exogenous, which is obviously beyond our control, and we can only push to a certain point. Where we focus, and I'm sure Chanel will take you guys through it, is you will see how cost containment has been a big, major discussion point within Delta, and obviously certainly the board has been very, very wary in terms of how we are communicating, and that will maybe be talking to the type of guidance that we're seeing going forward next year as well, as we see the turbulence continue. Just to recap and reintroduce, Delta is primarily leased out of our portfolio to sovereign underpinned assets, which basically have ticked up slightly to 77.9%. Historically, we've always kept that number at about a 70% margin. But I think as of last year, we came out with a 1.4 billion rand disposal program, and as we've been selling these the non-core assets, that number has been going up gradually on the sovereign side. Now, I think the part of the debate is, is it wise to be still sticking with the sovereign? And I'll touch on that as part of my conclusion, why we still believe that offers some opportunities going forward. And, the environment is obviously such that if DPW or government basically delivers on its promise, we are of the view that certainly the market conditions that we've seen in the last couple of years will obviously turn around. But we don't see that turning around probably before the end of 2019, and financially probably leading into 2020, to be honest, as the lease renewals start kicking in and so forth. And obviously there's a whole lot of work that goes into tenant reinstallations and so forth, which all precedes these renewals. I think there's been a huge effort from the team, and I must congratulate Chanil and Vernon and the team for maintaining the level 2 triple BE level under the new sector codes, which is a mammoth task. I think this definitely has not been easy, and it's something, obviously, as a company that deals with government, this is something very, very serious that we obviously take. I'm glad that Chanil and your team, you guys have done very, very well. I think market cap at 4.3 billion, I think, is just for noting. The key notes for us continue to be Pretoria CBD and the Durban CBD, and we'll touch on that under Otis's section in terms of how we're performing within those nodes. The magic number, I've always touched on that. Whoops. Did I switch it off or? Oh, sorry. The number, that 109.6 is the magic number for us. That's the average value per property. That number has ticked up slightly from the 101 million. Again, that is as a result of some of the disposals, as we've been selling some of the smaller assets and non-core assets. That number has ticked up slightly. Obviously, we had 112 properties. We're right down to 106 properties across the portfolio. Total number of assets, including our shareholding in Grit, is sitting at about 11.9 billion. And again, we still have our externalized 100% black-owned asset management company. Just a quick update on the leasing policy side. There was a market briefing by our biggest tenant, led by the minister and some of his key executives, in terms of what they planned to achieve on the bulk leasing side. This is something that we have been targeting. We have some 227,000 square meters that we've basically already submitted as a proposal. The guidance that they gave to the market is that they would like that process to be resolved by the end of December 2018. By our calculation, there's some 2,600 odd leases that government, bless you, there's some 2,600 leases that needs to be renewed in 6 months. I think that's a tall order. And I think if DPW does manage to achieve that, I think they would have done exceedingly well. Obviously, we will do our best to try and make sure that, certainly from a Delta perspective, I think we've been ready as of January 2017. We were ready. We've already given off our proposals. We have given quite some sweet discounts in terms of rentals, in terms of revisions, as we try and lure the long-term leases in return for long-term leases. But obviously Otis will take you through that in his section. The year under review, 21.6% of our leases are on a month-to-month. Clearly, this is of a serious concern to us. And again, this does form part of the proposal that we've put through. But if you look at the 21.6% of the leases, actually more than a third of those leases have actually been with us for more than 3 years, which is quite telling, to be honest, given that even though tenants are on a month-to-month, they do basically continue to pay and basically on a month-to-month basis. Ideally, this is not ideal from a landlord perspective, because we would rather have contracted tenants whereby we could then spend capex on these buildings. And I think it becomes quite a big challenge in dealing with the tenants who the user departments who are basically seeing, I must be honest, an ever deteriorating situation with the current buildings, whereby, they are paying on a month-to-month basis, and yet we are not able to spend as much capex as we would like, given the short-term leases that are there. So I think this is the message that we are sending to government, is that if they give us long-term leases, we are able to obviously spend a lot more and commit a lot more capital into the buildings. And I think part of the negotiation process will definitely tailor around the capex. I've already touched on the total exposure to sovereign being 77.9. I think the misnomer in the market also, particularly for those that don't follow the stock very, very closely, is that all 77.9% or revenue is that national government. We will show through the COO's presentation that only about 33% of our revenue comes from national government. The balance is mixed between provincial and state-owned enterprises and some municipalities there as well. So I think we do get some sort of variation from there, and there will be there's also an opportunity to obviously try and get some renewals from, particularly we've seen some huge activity, particularly at provincial level. On that point, we've also seen some private sector companies coming back into the CBD, but I'll touch on that on a later stage. Again, one of the major concerns from shareholders was the refinancing of our expiring facilities. During the year, we refinanced 941 million rands worth of debt, which I think is to be commendable, particularly given that our WALE was shrinking a bit. I mean, if you looked at our WALE was sitting at 1.5 years, it really does put us at a very, very tough position in discussions with our bankers, and I see a few of them in the audience there, and I think we've had some very robust discussions. But clearly, ultimately, I think we all share the same view. Ultimately, if the minister and his team delivers on their promise from last week, we basically have hit rock bottom in terms of how far things can go. We really need to put a major impetus in terms of turning the situation around. And, if one believes the narrative between the policy and the target in terms of the month-to-month leases, certainly we should see that WALE start to turn around, which then translates to better valuations in terms of properties, and obviously more capex that we're spending on those properties as well, which obviously helps our banking partners with their valuations as well. On the LTV side, this has gradually come down. For those of you who have long memories, I'm always told that the market has got a very long memory. This was sitting at an all-time high 2 years ago at a 49%. We've worked very diligently hard since the new management team came into being, and we're now sitting at 41.3%. But we're still not happy at these levels. Ideally, we would like that number to be below 40%. And dare I say, if our recapitalization of the business with the BEE Indlovu consortium does come off, we would like that number to be plus minus 30% or just below 30%. Maybe, or just if I can touch on the recapitalization or BEE transaction. Look, I think it's been quite a difficult period for us. We've obviously been trading in a closed period for quite some time, given that the BE consortium obviously has gone quite a long way down with the funders in terms of getting the funding approval. It's what we have been told is that the stumbling block is not actually with the transaction itself, but actually between PIC and GEPF, basically they're ironing out one or two things internally, which have actually impacting not only on our transaction, but also other transactions which are there. Clearly, it doesn't help when almost on a weekly basis there's press which is obviously picking up on some of the inner workings that are going on between GEPF and PIC, and we are hoping that those will get resolved pretty soon. I think we had my chairman can attest that we had a robust discussion about whether do we pull the cautionary until there's further announcement, or do we continue to basically renew. The essence is that we are being told that the consortium basically has an engagement letter with PIC, which either party has to give 30-day notice to cancel if the funding is not going to come through, or the BE consortium is not going to be tending up that funding. Neither party has cancelled that agreement. In fact, quite to the contrary, the funders basically have written to the consortium, and the board has seen the letter, which basically still shows that there's still appetite for funding of the transaction, and that makes the situation from a board perspective quite difficult, because some of the issues are not within the board's control, and we have quite specific utilizations for the funding as and when it does come out. So I think it's something that we will obviously be taking offline with shareholders on a one-to-one basis in terms of what is the sentiment, and I've made sure that we will give feedback to the board whether we may decide to pull the SENS, obviously subject to JSE regulations in terms of it doesn't mean that the transaction has fallen off. We have to walk a very, very fine line between regulation and obviously what shareholders being fatigued by the ongoing renewal of cautionaries. But we'll pick that up on the one-to-ones as we go around the country engaging with shareholders. I've touched on we've touched on the benefits, and I think we'll probably pick that up once the transaction becomes unconditional and the terms of that conditional of that funding becomes more clear going forward. I would like maybe just on this point, this market, given what's happening not only in the property market but just with some of the governance issues that are going on with some of the listed companies, there's a lot of rumors going around with anticipated share price and all of that type of thing. At this point, we are unable to communicate that firmly. So for those shareholders that are hearing pricing that the deal is going to be done at this pricing, at that pricing, I can categorically state that is not correct. We would have, if we had those facts, we would have communicated them to the market, and it's just speculation. Unfortunately, the downside of the weight is that obviously speculation does start to creep in from speculators and hedge funds. We do pick them up in the share register, obviously trying to take advantage of the situation as well. But I think once we have a strong balance sheet, we'll be able to make sure that we come out strongly with potentially a share buyback and all of those other revenues those avenues that will be open to the company to obviously make sure that the share price is not susceptible to manipulation or basically rumor mongering and things like that. In terms of the capital recycling, I think we basically started off with 112 properties that we had for disposal. We are down to 105 properties, and these are not the easy assets. Some of these assets are non-government related. They are not, in terms of size, the type of assets that we're selling are your industrial assets. They are really not core to Delta, and we're finding it quite difficult, particularly with funders obviously looking for more equity from potential buyers to try and buy assets, so it hasn't been that easy. One or two of the assets, particularly Block G, has been slightly delayed. We've been engaging with City of Tshwane and Rainprop, which is the prospective buyer. There are some regulatory issues that we needed to deal with between ourselves as we bought the property from Atterbury, to basically make sure that all the paperwork from a municipality perspective was all in order. And so we were hoping that that property, if shareholders do remember, I think we sold that property at about an 8%, 7% yield, which was very, very attractive for us. The building is within the DTI campus, and the rest of the buildings in that DTI campus form part of a triple P, which is run by Rainprop, and I think that triple P still has about between 15 and 16 years left, and that's the attraction from Rainprop's perspective. Vacancies have increased slightly. I think bad notes for us, particularly Free State, has been rather tough. We have lost one or two tenants there. The other bad note for us is obviously Sunning Hill. Eskom, going through their own challenges, has brought in-house basically most of the tenants that were leasing in the surrounding areas in Sunning Hill. They've all gone back to Megawatt Park, and they've asked SARS, who was actually subletting from Eskom, to actually move out of the Megawatt Park. So this has obviously created quite a difficult trading environment. Added to that, we see new nodes like Waterfall coming up. I think Waterfall has played a big part. I mean, PwC is a big tenant. I think you're talking about a 50,000 square meters of vacancy that they left in Sunning Hill, which will add further pressure to Sunning Hill. I think we will obviously looking either at potentially adding these assets on the disposal list, or finding some user departments like educational colleges, which perhaps could take some of the assets that we have there. I think Free State, as I've already touched, I think is extremely tough trading node. I think in earnest, I think we do need to spend quite a bit of capex there, because the buildings are actually well located. So the intention is that with part of the renegotiation on the 227,000 square meters of negotiation, we can certainly touch on what we can do for our prospective tenants in terms of refurbishing these buildings and spending quite a bit of capex to make sure that we can reattract some new tenants there. On the short-term performance, obviously, as I've already mentioned, there's some exogenous impacts on the short-term performance. These are issues that are obviously outside of our control. We obviously heavily reliant on terms of DPW, not only on promulgating the policy, but actually translating that to action. We took great comfort from the public initiative that the minister and Daya and the rest of the team went publicly to say by 31st December they would have basically renewed most of those month-to-month leases, and we definitely will make sure that we are front of the queue with that regard. The successful implementation obviously is dependent on PIC and GEPF sorting out their issues internally for that process to restart. From a Delta perspective, I think we are ready. We've got all the service providers, basically, who are the advisory companies that are providing services there, basically ready on the go to make sure that there's no lag as and when the process does come through. Obviously, coming off the elective conference, the macroeconomic issues. I think the president, he was last week, celebrated his 100 days in office. I think he's got a big task ahead. I think whilst the business sentiment has been overall positive, but changing the narrative from from where we were fearing a sovereign downgrade. I was quite pleased that from some of the rating agencies are now basically putting basically the sovereign on a stable outlook, which is a bit better than obviously where we were, where they had us on a negative watch going forward. This is obviously does play an impact. There's also talk of converging some of the government departments. We don't know whether this will happen after the elections or before the elections. There's, I believe, some work going on within government to try and streamline some of the government departments. We don't anticipate there to be much retrenchments. Clearly, they will still probably occupy some space, particularly in the key nodes like Pretoria from our perspective. I think the key thing that maybe the market may have missed is obviously the study that the potential move of Parliament from Cape Town to Pretoria will play a big part in boosting Pretoria. I think that's a big attraction for us to be in Pretoria. And I think given the level of exposure we have in Pretoria, I think we are well placed for such a move coming should the government pull the trigger on that front. With regards to the results that were announced today, we have the board has approved a distribution per share which is on target of 97.24 cents per share. This equates to 691 million rand for the full year. Again, this is, I'm sure Chanel will probably be at pains to say this has been achieved in a very, very tough trading environment, extremely tough environment, where we've got 21% of our leases on a month-to-month. So our ability to collect from those month-to-month tenants is very, very important. And our debtors is obviously something that we place heavy reliance on. Dealing with government, the first thing that people normally ask is, does government pay? There are horror stories of companies going under because of non-payment from the sovereign. I think at 18 days, I think the team is again showing its skill set and its ability to basically, despite the naysayers, that we are still able to collect these rentals within 18 days from date of invoice. As I've already mentioned, the vacancy has ticked up slightly to 11.8%, and I think we've got some pretty aggressive strategies to try and bring that down to probably under 10% going into the financial year next year. Having said all of that, on a positive note, I think we've renewed 93,000 square meters of existing leases, and we've concluded 53,000 square meters of new leases, which is an all-time record since the listing of Delta 5.5 years ago. So the narrative is that we are saying to the market is that, if the only thing that basically needs to get resolved from our side is that national government needs to get itself sorted out. Certainly, these two last boxes on the bottom right of the screen show that certainly at provincial level, certainly at municipal level, certainly at state-owned enterprise level, there's a lot of activity happening there. And but the big 800-pound gorilla in the room is obviously national government. And I think if we can get the 277 square meters of GLA sorted out, I think that will obviously speak very, very well and make our discussions with our funding partners a lot easier with basically our very much needed CapEx requirements going forward. With that, I would like to hand over to Chanel, and then I'll come through at the end for the conclusion. Thanks.
Okay, that's quite scary when the chairman runs off in the midst of the financial review. Thank you, Sandile. Warm welcome to the ladies and gentlemen in the audience. Yeah, I think the financial review, and I think Sandile has alluded to it, it's been quite a tough, challenging year for us, and I think under the circumstances, we've managed to achieve, I think, a fairly good set of results. We've been on point with our distribution target that we've committed to the market. So from that perspective, the management team, the team within Delta have really worked tirelessly to ensure that we keep to our commitment, and we have delivered on point. With regards to the cash flow in the business, 692 odd million rand worth of distribution for the full year. That's quite a big number. And, considering within the business as well, we've had to spend capex. So we have invested quite a bit of capex in the financial year. In our portfolio, if you look at our numbers in more detail, there's a number of about 180 odd million rand. So in spite of the shorter WALE, we are still ensuring that our portfolio is maintained of a standard that we require. And, it all comes at a cost. So I think, I see our banking partners here in the audience. I must say from a financial perspective, a big thank you to them. They've really been aligned with our strategy. They understand from a government perspective, even though we've got shorter WALEs, but funds are flowing. It's not like government is not paying. It's just that they a little bit skeptical to sign a piece of document and give us a committed lease. But the fact of the matter is that the cash is flowing into the business. So from a financial perspective, these have been some of the challenges that we've had during this financial year. And with that being said, I just want to take you through some of the highlights. And Sandile has touched on them. But I think just to reiterate as well, for us... Sorry, is it? All right. So I think for us, the LTV, as mentioned as well, this is the third consecutive year. We have made progress, even though it hasn't been that significant in this financial year. But again, 41.3% for us. And again, we benefited quite significantly from the lease renewals that materialized in the business this year. That obviously helped with the fair value of our portfolio. We saw a net increase of about just under 270 odd million rand. So that obviously gave us a bit of headroom, and that helped us to bring the LTV down. For us as a management team, challenging ourselves, we obviously would like to see this closer to the 40% mark, barring any of the proposed transaction that Sandile has mentioned. So once the longer term leases materialize during this financial year, we are obviously expecting this number to improve quite significantly. But for us, the LTV is one of the numbers that we live and breathe by on a monthly basis in the business. From a refinance perspective, as Sandile has mentioned as well, 941 million rand. And I think just to give some content to this number as well, of that 941 million rand, we did settle 125 million rand of commercial paper that we had, which was expiring. So in essence, we rolled over about 816 million rand worth of bank facilities that came up for refi. And if you look at that 125 million that we settled that in cash, which came off from the disposals that materialized during the financial year as well. So there was a bit of a bridge for a short period of time, but we managed to settle that from the disposals. And I think there again, if you look at those facilities of 816 million that we did refinance, taking into account the WALE of the business, but again, I think the positive news emanating from the business being the fact that we do collect our funds. Our debtors days of 18 is obviously very, very good within our sector. We've managed to refinance that expiring debt effectively at rates on a weighted average of about 260% over 3-month JABA, which I think is fairly respectable. I think it's still a very, very competitive rate. So I think it hasn't been bad for this financial year. From a debt perspective, fixed debt, that is another significant metric in our lives. 80% is the sweet spot for us to ensure that we are always hedged over 80%. And I think that's what our shareholders demand and feel comfortable with. So 85.4, that has ticked up slightly. And, if you look at the level of fixes that we have in the business, we've got about 3.6 odd billion rand worth of fixes. Majority of our fixes are from our interest rate swaps. We've got about 2.7 billion rand in interest rate swaps. Bank facilities, just under 800 odd million rand, that's fixed. And then we've got a small portion of a cross-currency swap of about 125 odd million rand. And the cross-currency swap is there in essence to match a dollar funding that we've got with the Bank of China. So those two effectively correlate to each other. Again, from a debtors days, well managed at 18 days. You will, however, see in our integrated report as well that from a provision perspective on debtors, we have in this financial year increased our provision by about 5.5 million rand. And I guess there as well, I just want to emphasize our provision that's sitting at just under 12 million rand. We do not have any provision for any government related tenants. All of the provision that we do have in place is for the retail tenants that we have. So, you would understand that during this year, it was quite a tough economic environment. We do have quite a bit of retail space at the bottoms of our office buildings, and the retail clientele have obviously been affected by this economic environment. So with that being said, we do have legal debtors in the region of about 17 odd million rand. So we have taken a provision. We've increased it by 5.5 with a total provision of about 12 odd million rand. On the aging side of things as well, you would see when you get the integrated report that our debtors have increased, especially over 90 days, you'll see by about 20 odd million rand. There's two specific tenants that we are currently engaging with. And that engagement is ongoing. It's fairly positive, and we are comfortable that amount will be collected. So we don't foresee any issues with that at this stage, but there has been a 20 million rand increase. But with that being said as well, if you look at our debtors balance of just under 100 million rand versus revenue of just under 1.6 billion, I think we're still on point with regards to managing our collections in the business. Our property operating margin, and I think just to give some context to that effectively translates into a gross cost to income ratio of 26.5%. On a net basis, we are operating at 12.1%. So here again, we did benefit during this financial year in that we received some municipal credits that were due to us. And if you had to look at our business more from a normalized perspective, I think we've always communicated to the market that from a gross perspective, 28 to 29% is where we should be operating. So on a normalized basis, that is where we should actually be, barring the credits that we obviously received during the financial year. Interest cover ratio 2.4. Our banking covenants are minimum 2, so I think we're well within our banking covenant range of 2.4 that we've delivered in the market. Okay, and then just from a 5-year review perspective, if you look at our revenues has come off. It's declined 3.1%. But with that being said, the major part of the decline comes out of our disposals, which Sandile has touched on as well. We've had quite a huge portfolio, the Educo portfolio. In total, there was about 316 odd million rand that was disposed of. But also you had in the previous year disposals that were done partly during the year. So when you obviously now do a like-for-like comparison, this is where with the disposals coming off, it obviously influences your contractual rental income, plus also on the recovery side of things. So majority of the 3.1% has come off from the disposals. There is a small element as well that's been impacted by the vacancy level that has upticked. So as an example, if you look at the Enterprise Park, which is part of the Sunninghill node, there was a contribution in the prior year, whereas in the current year it was almost negative, very, very, very close to nil. So that obviously had quite an impact on the revenue numbers. Net property income, the explanation is almost correlated to revenue as well. From a finance cost perspective, that's ticked up slightly by 2.5%. And a big part of that increase as well comes out due to higher debt structuring fees that we've amortized. Comparatively, if you look at the prior year versus the current year, there's an additional 6 odd million rand. But also, with regards to the debt refinance, a margin of about 260 basis points for 6 months versus the prior period of about just over 200 basis points has had a very slight impact on the finance costs that that has materialized in the business. We've covered the cost to income ratios as I've explained. Investment property, I think there as well, that's the revaluation that it's just under 2.3%. The benefit again coming out of the leases that materialized in the business. So that has actually helped our LTV and benefited us quite significantly. The investment in our listed security, that's our investment in GRIT. At financial year end, our shareholding in GRIT is about 11.5%. And you will see that our shareholding has, in rand terms, come down by about just under 48 odd million rand. At financial year end, Feb 17, the share price of GRIT was 18 rand. Feb 18, 16 rand. So that has obviously had an impact on our LTV as well, where we've had other metrics that have pushed the LTV up. Unfortunately, the shareholding in GRIT has been a bit of a drag, but we're hoping, obviously, with the initiatives that GRIT are currently embarking on, mainly the potential listing, we're hoping to see some sort of re-rating in that stock, which could help the value of our stock. But I think Sandile will touch a bit more in his conclusion regarding our medium-term strategy around our investment in GRIT. On the borrowing front, we haven't done anything significant. The major part of that movement is the commercial paper that I alluded to, the 125 million rand that has been settled. Our gearing 41, weighted average interest rate almost the same. You haven't yet seen the full impact. We should see, depending on how the refinance goes through for this financial year, this is a tough year. We've got about 2.2 billion rand, or just under 2.3 billion actually, that's coming up for refinance. So, we are obviously pushing fairly hard to get these leases signed. Because with the leases signed, and obviously with where our LTVs are, we could see, from a pricing perspective, we are hoping to ensure that pricing doesn't take us off the mark. We have currently heard about the whole Basel III implementation, the costs that are coming through with Basel III. So with all of this in consolidation, we're hoping to try and maintain not a significant jump in pricing. So with that being said, I think as we progress, we'll probably be able to give the market a better indication at our interim results as to where we've progressed. Again, with the debt expiry, the debt fixed expiry, these are also very closely correlated to the lease term. So again, these are all bordering on the leases and the tenor of the leases materializing, and then we'll be able to obviously apply some sort of matching with regards to these terms. Net asset value, 991 to 10 rand 6 cents. Again, the benefit coming majorly out of the fair value on the property portfolio. Okay, on our distributable income statement, I think this is just a reconciliation from your IFRS income statement to the distributable income that we have declared to the market. So if you just go down the line, and maybe just to make some comments. Admin expenses, there's been quite a significant decrease, but I must comment, and you would see in our SENS, we've obviously made mention that there was some relocation that has taken place, and the relocation is also is mainly due to the fact that from a head office perspective, we used to use an accounting system that was different to the property managers. So where the property managers used MDA, head office used to convert this into Pascal. We then migrated and set the benchmark aligned with the property managers and implemented MDA at head office. And with that being done, we picked up there were some mapping issues with some of the accounts. So we've remapped 2 line items to property expenses. With that being said, on a normalized basis, we've still managed to bring our admin expenses down by about 2.3%. So even if you look at this number from 68 to 53, it appears that it's a 22% decrease. And I'm saying the reallocation had quite a role to play in it. If you had to normalize it, we actually decreased it by 2.3%. And that again speaks to what Sandile mentioned earlier on, the austerity measures in the business. We've been very, very hard on our cost. Cost containment has been a big priority in the business, and I think we've managed to implement that fairly successfully. Finance costs. So this is obviously the net finance cost that's been depicted on the slide. This is after interest income. On interest income, you would see that our interest income has declined as well. You would recall that last year we had the cash back guarantee for the investment in Baystone. Once that was disposed of, that cash was obviously released. So the interest income attributable to that investment obviously is what has been lost from a finance income perspective. From a dividend income grid perspective, the decrease here, I think just to emphasize, in dollar terms, the distribution from grid, or our investment in grid, actually increased by about just under 3%. The decrease that you see here is purely a function of the currency, of the translation that effectively takes place. So in real terms, in dollar terms, our distribution has increased by just under 3%. Sundry income, for us, that's quite a big jump, 14 million rand. And I'll speak to that in respect of our guidance as well. There was some tenant reinstatement costs that came through this year for a tenant that moved out of our building, which contributed almost 13.6 million rand to that increase. That is obviously a once-off adjustment, and in our forecast, we have adjusted for that. So when we speak to our forecast, this is one of the numbers that has been taken off the forecast. Antecedent interest, you would recall at interim, we offered the dividend reinvestment. We had some take-up, about 1.2 million shares. So this antecedent relates to that 1.2 million share take-up, which was issued at the 1st of December, and that's the pro rata amount. Distributable earnings, the 3.3 million, you would recall last year, that was retained, and that was obviously released in this financial year. So the reconciliation from net property income, and that gives you the distributable income that we've declared of 691 million, which then equates to 97.24 cents per share, being the flat growth that we did communicate to the market and provide guidance. Okay, so this is just diagrammatic representation of the growth in distributions. I guess for FY17, FY18, it's been flat. Like I say again, been a challenging year for us. And I think we've still done well with in the face of the challenges that we have experienced in this financial year. The earnings bridge, this is just a depiction again, prior year to the current year, exactly all of the elements that we have discussed and how they've contributed positively or negatively. And this just gives you a graphic representation for you to peruse. On a like-for-like basis, if you look at the portfolio, the bottom line, 5.2%. I think we did communicate a little bit higher last year. If you look at our in-force escalation, however, Otis will probably touch on it in his section as well. Some of the renewals that we did do in this financial year, there was a bit of reversions that came through. But I think holistically, 5.2 is still fairly respectable in respect of what it was within the range that we sort of expected. So I think we've still done, the ops team have done fairly well to negotiate around those rates at 5.2%. So this is just a summary, the statement of financial position. And I think we've covered quite a few of the elements, with regards to the non-current assets. Like I said, the investment property increase, purely the fair value adjustments. Investment in associate, that's in grid. The non-current assets held for sale, 1.3 billion, we've come down to 972. Of the 972 million that we have, there's about 326 odd million rand that are committed to sale agreements, of which Block G is the significant contributor. So with that materializing, if you take off the 326, effectively it means we've got about just under 650 million rand that has not been spoken for. So that's going to be the hardest sell. And as Sandile has mentioned as well, those are the assets that we have where there's higher levels of vacancies or they're non-core to the portfolio. So in essence, that's going to be a bit more difficult sell. But again, the team is highly committed and we're going to do our best to see how we manage those disposals. And then just walking down the financial position, you've got the non-current liabilities, 2.7 billion. The biggest component of that is our borrowings, which is about 2.7 odd billion. There's a small component of the derivatives that sits in there. Current liabilities, like I mentioned, it's under 2.3 billion rand, is the short-term portion of our debt that expires in this financial year. And the balance is your trade payables and an overdraft that we have in the business. Okay, then again, you can see we like these fancy graphs, all of these bridges. So the net asset value, again, just showing you exactly the positive contributors and the negative contributors. That eventually takes us from the 991 to the 10 rand 6 cents. Okay, debt summary perspective. It's 4.9 billion rand worth of debt. I touched on the fixes earlier on, the 3.6 billion. And in summary, that's how we come to our 85.4%. This is just a graphical representation of the 4.9 billion rand worth of debt. So it just shows you with regards to our rand funding, 4.7, that's the major component. The US dollar funding that we have, very small component in the business. And then obviously the financier split. Nedbank at 3.2. Standard Bank, just under 900 million. Investec and Bank of China. You would see with regards to the classification, majority of our facilities are floating, fixed about 800, and we've got about just over 600 worth of revolvers in the business. And the fixed debt breakdown, which I alluded to earlier on. Debt expiry profile. So Feb 19, by far you would see this is where the major challenge lies for us, the biggest task. And again, this speaks to the 2.2 billion rand in this financial year. So obviously, depending on how we manage to negotiate facilities in this year, will affect the complexion of 2021, 22, hopefully up to 24, 25 in respect of the renewals going forward. And I think just a bit on the debt commentary. We have touched on it on the earlier slide on the 5-year summary, but the weighted average cost of funding 9.2%, the debt facility of 1.5, the interest cover ratio, and again our long-term intention to term out the debt expiry profile. Just with regards to the 941 million and the blended margin of 2.6%, that has materialized with regards to the pricing, the 125 commercial paper that we have settled. And I think at this stage, just to give some content to the guidance that has been put out on SENS, the 2 to 4% that we are looking to revert. And I guess a big part of that speaks to the once-offs. I mentioned the other income, the additional 14 million rand. But with that in mind, there's quite a few factors that went into play or into the calculation coming up to that reverted amount. So one being with the imminent, and we hoping that it will materialize this year, being the reversions in the DP that come out of the DPW policy. That for us is quite difficult to actually put an accurate number to, because it's based on what terms or tenor that DPW select out of the menu that has been provided to them. So there's been a whole range. There's a 3, 5, 7, 9, 11. And each one of those tenors has got a rate ascribed to it. So depending on where or what they select, that will have an impact. So Otis will allude to that a bit more. We've sort of taken the middle ground here with respect to our forecast. And if you look at our core portfolio, we're looking at a 6% increase with regards to the rates. You then have the reversions. You then also have an element that's going to be coming out of the disposals fully once the 360 odd million that I alluded to materializes in the portfolio, and obviously the once-offs of about 14 million that we've taken out. So with that being said, the range we've given is between 2 to 4%. The other big factor, which we have been speaking about since last year as well, is the last tranche of shares, that 15.5 million rand that we need to issue for the Free State portfolio. So at this stage, we haven't issued it as committed for November 17. We have managed to kick that can down the road. So at this stage, I think this year is going to be the silver bullet year. We're going to have to issue that in this financial year. And that share issuance on its own has a dilution effect of about 1.7 to 1.8%. So you have to sort of read this in context with regards to the operational aspect and the share issuance that contributes to this entire 2 to 4% range in dilution that we're speaking to. But again, I think, with that being said, if you have to look at the range and obviously, do the math with regards to the distribution of, let's say, 94 odd cents, and where our share price trades, whether it's 650 up to 7 rand, we believe Delta still offers a very, very good yield at that share price. And, from a management perspective, I think the real stretch for us this year is to ensure that we minimize whatever reversions come out from the leases, the sale of our portfolios, to ensure that we get as much settlement that we can from debt, from debt that's coming up for refinance, to have that trade-off between the non-core assets in the business, and just to manage our gearing level. We've also got our rating that's coming up within the next month or two from GCR. So, we need to try and improve on that. We do have quite an extensive DMTN program. That's about 2 billion rand, which is fairly unutilized at this stage. So there are quite a few opportunities that are available to us, and I think this is going to be quite a tough year. And I think with that being said, I think the management team are going to build up some strong muscles together with our team seated here. And we're hoping that we can deliver to what we're committing here to you guys this morning as well. Thank you. With that, I hand over to Otis.
Good morning once again. Welcome. I think it's been a very, very tough, challenging year. We've seen our vacancies going up. We've seen our WALE coming down. Our disposals have actually slowed down. But as the CEO alluded to earlier, it's all exogenous factors that are really beyond our control. Having said that, it's not all doom and gloom. We've had some successes. Most of you will have attended the DPW conference that took place last week. The minister himself was there with his entire team. There's a lot of phoria going around with the Rama phoria coupled with the Nesi phoria. Nesi is back. The department has been in dire straits, but with dire coming back, he was quite bullish, and he's made sure that going forward we'll be able to get things done. They've given themselves a very ambitious target of 31 December. The total number of leases in government, national DPW, is actually just under 2,500. Of the expired leases is about 1,250, and they've set themselves a target of renewing all those by December. Talking to Dai and his team off podium privately, they've indicated that they want to renew in actually 3 months for the top 80 landlords, because the top 80 landlords actually make up 60% of the expired leases. So touch wood, we should have the bulk of those leases renewed within the timeframes that they've set themselves. What is different about the meeting that was there this time is that you had SIU, you had Treasury, no less a person than the DG of Treasury himself committed to the 31 December deadline. So that gives us a lot of confidence that these things will actually be done. My duty today is to touch on 5 key elements. We had a pre-close and a lot of our shareholders had a few questions around the following 5 factors, which I'll try and cover. The first one being the policy itself, the second one being around the leases, the third being around our CAPEX program, the vacancies and the actual disposals. In terms of the policy, there was a version that was signed on the 31st of January 2018. That had a lot of input. Sysposia from the Property Sector Charter Council engaged with a lot of all the user departments, with a lot of support property related bodies. So it was quite a consultative, a lot of participation from people, and was quite wide ranging. It covered the smaller property players right up to the big listed REITs. So that policy was signed under the watch of the previous minister, Minister Nathi Nhleko, on the 31st of January. We understand that it is still work in progress. There's 1 or 2 elements that they need to tweak on, insofar as we are concerned, being a blacklisted fund and what it means for us actually in terms of that. But notwithstanding that, the bulk proposals have commenced in earnest. There's been a high-level team set up, made up of Treasury and made up of DPW. That team has got professionals. We had our first engagement in about February. Being the top landlord in the government space, we were first up. We put our entire portfolio, made up of 59 buildings, totaling 227,000 square meters, and we went through each and every property in terms of the negotiating. We gave them a mixed basket from 3 years to about 911, with the 911s attracting lower rentals between the 95 rand a square to about the 110. And for the shorter term, we tried to discourage the shorter term leases and offer them higher rentals on the 3-year profile. What we've seen is that the actual user departments are going to be playing a very big key role in terms of the actual renewals themselves. So in as much as there's a policy that needs to be finalized, the user departments are playing a bigger role. If they're happy in the building and you come up with a maintenance plan, they are happy to extend in the actual lease agreement. As Sandile alluded to earlier, we're still pretty much a sovereign fund. 73% of our income by GLA comes from the national tenants and the state-owned enterprises as well as the municipalities. Just under 80% of our income comes from the sovereign. We'll touch on later what actually makes up the sovereign. That number there, the 95,000, 93,000, just under 100,000 square meters, is the best that Delta has done in the 5.5 years of listing. That is made up of about 95 leases. On average, we're looking at renewals of about 3 years, with escalations ranging between 7 and 7.5%. The bulk of those renewals have been done at about 100 rand a square meter. Our vacancies have ticked up slightly from the last time we reported. They're just slightly over the SAPOA national average at 11.2. But as we delve deeper, you'll see that in the sovereign office space, we're under 7%, which we're quite pleased with. The bulk of our vacancies have come from 3 main areas. The first one being the Free State portfolio. When we bought those buildings, we knew it fitted with our strategy. We were buying buildings with short-term lease profile in the hope that in the knowledge that we'll be able to renew the leases. We've taken a bit of a challenge in that in the Free State, there's local empowerment, which plays a big part, where they want to see local players versus just normal triple BEE. And then the second node where we're taking a challenge is in our Eskom Sunninghill portfolio. Eskom relocated to the Megawatt Park, and that released about 20,000 square meters of vacancies in the Sunninghill node. Of that, we've managed to renew or relet 2,000 square meters to a medical aid company, which has taken up a 3-year lease. As we speak, we've got one of the buildings, about 3,500 square meters, which is under offer, which we're evaluating. In terms of the new leases, we've done 54,000 square meters, which we are also pleased with. It's the highest that Delta has done in any reporting period. The bulk of that new lease is in areas like Pretoria. We had a building called Department of Stats As you recall, Department of State's built their own head office at 2.4 billion in Pretoria. They relocated and left 14,000 square meters. We were quite successful to relet that within 60 days. We got a PIC aligned company, which is Compensation Commission, who took out a 3-year lease at about 115 Rand a square at 8% escalation. The other building that we let out is Commission House, which is occupied by Department of Public Enterprise. The building measures about 6,500 square meters. It will house Minister Pravin Gordhan. He is quite happy with the CAPEC, with the refurbishment that we've done in the building, and he should be taking occupation on the 21st of June. That was done at 110 Rand a square, 3 years, 7% escalation. In terms of the bulk proposal, I touched on that earlier. We've done 59 leases. It's 227,000 square meters. It's a mixed basket. In our engagements with the department and with Treasury, we concluded on pretty much long-term leases on the bulk of those proposals. In there, we've clustered them. The big cluster would be the subs. Of the 227, about half of the department's subs and Department of Justice and Department of Water will make up about half of that 227, have already concluded that they're happy to renew. In terms of that, one or two of our competitors have released their results. They've alluded to the market that they've renewed the leases. There's actually 3 stages to the renewal. Stage 1 being the engagement with the Treasury and the DPW. We've concluded 59 leases in terms of that engagement. DPW in total have done 104, of which Delta has the 59 leases in there. So we are first up the line. And when we spoke to Daya this morning, he mentioned that even though they've set 31 December as a target, in terms of Delta and the other top landlords, we should be done in the next 3 months. That's just a graphical representation showing that we've come down slightly from the 1 million square meters that we had. We've come down to about 952 as a result of the disposals that we've done. Gauteng and KZN remain our biggest nodes, and that's just a reflection of who some of our blue chip tenants are. We've left that map in. It just shows in an area like Pretoria where DPW have stated the areas that they want to be in. The area called Salvocop is a land parcel that DPW have assembled, and they're looking to put up 1 or 2 new departments in there. Department of State, the 2.4 billion was actually built in that area. And I'm happy to say all our buildings in Delta are well located within the yellow box of that. Our number of properties have come down from about 112 to 105. We've sold 7 buildings, which totaled about 316 million Rand. We took a small haircut, about 10% haircut on those initial disposals. We've got another 5 buildings that are under offer where we are breaking even. So when you look at all our disposals, we've taken a haircut of just under 5%, which in the current economic climate we think is not too bad to have achieved. The vacancies, when you look at the slide on the vacancies, you'll see that in the sovereign space we're under 7%, which is acceptable. We normally like to keep a 5% vacancy in our portfolio to allow for expansion as our user departments grow. We've taken a big hit in office other, which predominantly is made up of our Sunninghill node. That's where the vacancies are. And if you look on the industrial, that's quite high. Industrial is quite high because we had a portfolio that we bought in 2013, the Protea Coin portfolio. The leases came to an end, and that companies, they've moved out of the buildings. So we are trying to sell those buildings. So most of our vacancies are not in the sector that we specialize in, but more in the other sectors that we're not too specialized in. In terms of our valuations, you'll see that our growth in valuations has been minimal. That's reflective of our valuers. We're not happy to take long-term views on our portfolio based on the short-term lease profiles that we have. And what we've agreed with our board and our valuers is that once we conclude the new leases, we'll relook at the valuations and look to go to revalue the portfolio. So the current growth is just under 2.5%. In terms of our average rental, it works out to about 110 rand a square meter. We've had some slight reversions in the 95,000 square meters that we've renewed, but we've not fared too badly. We are quite happy with that current rate. We are aware that in some nodes the rentals are higher on our competitors there. In terms of the WALE, that's a number, 1.5 years. Most of you will recall when we listed 5.5 years ago, our WALE was about 7 years. It has come down due to the non-renewal of the leases, currently sitting at 1.5 years. If you look at that 1.5 years, of the 227,000 square meters that we've submitted for renewal, 35%, just under 72,000 square meters, is made up of tenants who've been in the building for more than 4 years. And then the other 65% has actually been in occupation for the last year. So in essence, if you take out the monthly leases, you'll find that our WALE is just under 2 years as opposed to the 1.5 that we're reporting on there. I won't touch on the cost to income ratio. Chanel has touched on that, and the net income earlier. On that sectoral split, it just serves to show what the CEO alluded to earlier, that there's different components that make up the actual sovereign. We've got national making up about 33%. We've got provincial making up half of that, and the state-owned and the municipalities forming the balance of that. Sorry, this slide here just shows you 40% is actually national, 16% provincial, and that. In terms of the policy itself, I did say there's a version that has been signed. The version still needs a bit of work. DPWU and the minister and DIA have committed that in the next 2 months they are going to come out with what, delve deeper into the actual policy to say what it means for us. We know from what we've heard that they're concentrating on the following things: the ownership level, the management and the board control. Delta, as one of the black REITs, scores quite highly on the management and the board control. And in the next 2 months, they have undertaken that they will come out and break it down and really decode what that policy means. Notwithstanding that, they have said that we'll embark on the renewals. And in terms of the renewals, we've given them a empowerment plan, which will be taken into account. One big thing that came out of the conference on Thursday last week is that they're looking at your maintenance plan. The user departments are having a bigger say in terms of the quality of the accommodation. If the accommodation is up to scratch and you come with a maintenance plan as to what you're doing, you stand a higher chance. And as you can see, Delta from 2012 has been doing this kind of thing. This is the maintenance plan they're looking for, where they're asking you to show them the building in its current form and what you intend doing once you get the lease agreement. So that is the maintenance plan that is better known as Schedule C, which Daya was alluding to at his conference, that everybody has to go and come up with a maintenance plan for each and every lease agreement that we are submitting. So currently there'll be the scoring on the leases will be looking at your pricing. There's a big push for government coming from the Treasury Department, where they want to pay market-related rentals. 2 concessions we got from the roadshow on Thursday is that DPW for the longest time has been depending on Rhoda Report for their market-related rentals. Now, those of you that follow Rhoda know that he does not really take into account a lot of input. So the information that he uses is really skewed, depending on the brokers in the area. So you'll find that in a small town like Bloemfontein, Nelspruit, the rentals are higher because the agents in those areas are pushing the rentals. And in a bigger area like Pretoria and Johannesburg, where there's limited brokers giving input, the rentals are skewed. So the concession that we got, thanks to 1 or 2 participants on the roadshow, Crystal Scott sitting in there, was that Daya has now agreed to come up with what he calls a moderation. They've now woken up to the fact that they're the biggest landlord in terms of government. So what they're going to do is they're going to meet all the top 80 landlords, negotiate the rentals, and then they'll do what they call a moderation, where they look at the rentals, so that by the end of the day, there's not too much discrepancy between one landlord to another in the same area. There will be a variation, obviously dependent on the quality of the building, the location of the building, but it will not be too heavy a variance. And then the other concession that we got as well is that in terms of the new lease, government had pushed the rates and taxes to the landlords. We've now got a concession from Daya and the team where they've said they'll consider taking on the increases in the rates and taxes, which will bode well for us. Of the 104 leases, Delta has got more than half. Our maintenance plan is ready. We just need to tweak one or two numbers and we should be ready to submit and get our leases renewed. If we get the 227,000 square meters renewed, our WALE will increase from the current just under 2 to between 4 to 7 years, depending on where we eventually set on in terms of the renewals. The 100,000, just under 100,000 square meters is a number that we're quite chuffed with. It's 309 million rand. It's made up of those leases, those that are key ones. A lot of our shareholders asked in the pre-close to know which are the leases and how you've got those 100,000 square meters. So in Pietermaritzburg Capital Towers, just under 14,000. It's 2 years. We renewed that for 2 years now because the department is obviously waiting for the finalization of the bulk proposal and the leasing policy. Thereafter, we should be able to renegotiate those 24 months to a longer term. In Polokwane, Timo Towers, we bought that building when the lease rentals were high. It was sitting at about 150, 170. We've come down, but we've managed to get ourselves a 3-year lease with an 8% escalation. So that just shows the actual key leases that we've renewed. Standard Bank in Durban have renewed over 5 years. And in SARS, we've managed to renew the SARS. SARS has been doing some downsizing, but the SARS in Pietermaritzburg, Sleepy Hollow, we managed to get a 5-year lease. In Randburg, they gave back some space, but we got a 3-year lease out of them there. In terms of the new leases, those are the key ones that we've done, just under 200 million rand. The key ones being in eThekwini municipality. We got just under 15,000 square meters there, concluded over 3 years. Delta Heights, the compensation fund, is that new lease that I alluded to, where the PIC aligned compensation fund have taken a 3-year lease at 115 rand a square meter. And then Commission House is where Mr. Praveen Godan is moving in. We've concluded a 3-year lease, 7.5%. We've spent quite a lot of capex on this building, and we're now in discussions with Daya and the DPE team to get the 3 years extended into a 10-year lease. The Mr. Price lease is a small lease, just under 2,500 square meters. We've highlighted this because, it's a 10-year lease, and Mr. Price is looking to take on an additional 4.5, showing confidence for the building. That's just a graphical representation of what we've done. The 95 leases have seen a bit of reversion, just under 5% on that particular basket of renewals that we've done. In terms of the bulk proposal, once we conclude, we'll then be able to come up with actual numbers as to what the reversion is expected to be there. Should we succeed in our quest to get long-term leases, we think that reversion will vary between 2 to 4%. That just shows, again, a graphical representation of where most of our income is coming from, being Gauteng and KZN. On the acquisition front, things have been very quiet. Our last acquisition was a redefined portfolio. We bought properties there that fitted in with our strategy. They had long-term leases that were coming to an end in terms of second treasury dispensation. The majority of those leases expired 31 March. And when we bought the buildings, we knew there was a lot of work to be done on the buildings. But because of the non-renewal of leases, that has been slow. And as the new leases come in, we'll be able to apply and get capex facilities from our funding partners that we can then apply into the buildings and do the necessary refurbishments, and renovations. Coming from the conference again, we saw a lot of the user departments being quite vocal. They're looking for quality space, not only for the staff that work in the buildings, but for the customers that come and use the buildings. So there's a lot of emphasis going forward on the capex issues. In terms of our acquisitions, while we were working on our BE deal, we had lined up a parcel of properties from one or two other funds. That is on hold pending the conclusion of the funding of the BEE strategy. But our numbers remain, our average size of our assets is just over 100 million rand. We remain focusing on government assets for now. In terms of disposals, I think Shanil touched on that earlier. We've done about 325 million properties, made up of 7 properties that have transferred. We took a 10% haircut in those ones, and we've got another 4 buildings that are under offer where we're breaking even. Of these 4 buildings that are under offer, I just want to touch on Block G. That's a building that we sold to the consortium, Rainprop. We sold that at a 7% yield. The delays have been based on issues that are really out of our control. When we bought the building, we bought it from Atterbury. The actual building is located on a municipal land lease. What happened when we took transfer is that the session from Atterbury to Delta did not take place correctly. And now we are engaging municipality to do a double session from Atterbury to Delta and from Delta to Rainprop. We've had a lot of meetings with Treasury, municipality, Rainprop, and the lawyers and the funders. So the sale agreement is still very much alive, and touch wood, in the next 2-3 months, that property should be transferring. Again, Top Trailers industrial building, which is in line with our issue to dispose of non-core assets. And then Broadcast is a single building, the only asset we have in Mthatha. We got a decent offer for that, and we're looking to dispose that. In terms of capex, obviously linked to the leases, when you don't have lease agreements, it's hard to go and knock on the bank's doors. We're unable to get any joy from the banks, but we've got an understanding with our banking partners that once we secure the long-term leases, we'll be able to come back and look to put capex facilities in place. Having said that, we are a responsible landlord. We are trying to keep the buildings functional. You can understand that if we bought the buildings needing capex, with the passage of time, the situation is worsening. But what we are doing in our limited resources, through blood, sweat, and tears, and some punch-ups in the background, we are trying to get the emergency capex done on the buildings. So I think we'll continue pushing and trying to keep the buildings compliant. Because DPW, when you go to them and you tell them that you don't have a lease, that is why you can't look after the building. They're not buying that argument. Their answer to that is, we are paying you rent, you need to give us functional, habitable, usable buildings. So we are trying to keep things, the lights on with the limited resources that we have. And then going forward, when we embark on our capex program, when the lease agreements come, we'll use the opportunity to look at greening. That's one of the things that DPW and the property industry at large is looking at. So we'll put waterless urinals, energy-saving lights when we start doing the capex program. That's just what we've spent in the past few years. The bulk of our capex program has been driven by lease-backed assets. Commission House we embarked on because we got a lease. In Beacon Hill we got a 5-year lease, hence the 40 million there. Sleepy Hollow we got a lease from SARS. And in 17 Harrison, we got a lease from Johannesburg Water. And most of our capex has been driven by lease-backed things. There's 1 or 2 which are compliance-related, where we've had to do them in spite of the limited cash flow, as the tenants were threatening to vacate the building if that wasn't done. Hand over to Mr. Nomvete there.
Thanks. Apologies. I know that our presentations do tend to be slightly longer than some of our competitors, but we normally believe that the more transparent we are, the more factual information or the more questions or the more detailed decisions our shareholders can make. Just on the conclusion front, I think it's quite clear that we've got our work cut out. We are heavily dependent on our big tenants basically renewing their leases. That immediately is obviously interlinked with our ability to undertake major capex. So the two go hand in hand. And as Otis was basically just finishing off, I think there's a mismatch at the moment where you've got a user department which says, I'm paying rent, I should be having brand new lifts, I should be having brand new ablutions and so forth, with traditional property fundamentals which says, give me a commitment to stay in the building and we'll invest. And I think we've tried to show, it's just a pity he went through very, very quickly on the capex slide. We have really tried to show that, where tenants have basically committed, we basically have undertaken those major capex projects. If you look at particularly at our portfolio down in Durban, I think you will see that most of those buildings do have some leases, the likes of our lifts and so forth, and the likes of capex. Waterproofing issues has been a major issue that has been sorted out. Clearly, the other focus is WALE, getting a WALE that is obviously acceptable to ourselves. Ideally, that WALE should be probably in the region of about 5 years, honestly speaking. I don't think, given the sovereign underpin, I think that is quite an important direction that, particularly from a treasury perspective, they need to give guidance. People will remember that the previous finance minister was on record to basically say that from a treasury perspective, they're quite open from a long-term leases to be reinstated again. That is because we have demonstrated that financially, on a month-to-month leases, it's actually costing government more to be on a month-to-month lease rather than being on long-term leases. And you can see it in our numbers. The longer the lease, the more we are prepared to bring down our level of rental, obviously with more certainty. The quality of revenue obviously will make the business case a lot more compelling. I think the recapitalization of the business injection, I think part of that is not to settle debt. I mean, if you look at the cost of debt that we're getting at the moment, we will rather reduce our gearing by actually growing the portfolio size. That's point number one. But two, more importantly, what is becoming abundantly clear from us is that we need to be able to spend a lot more money into capex, whereby our tenant retention and obviously even attracting new tenants will be our competitive advantage. I think those property fundamentals, as the department starts signing new leases, will obviously come to the fore, and it's something that will be key. Clearly, Chanel, with close to 2 billion rands worth of debt, which is expiring this year, that will also assist with having a healthier balance sheet. I must add, though, that those discussions on some of the renewals have already started, and we obviously started with our banking partners in terms of where we see those negotiations going. They've been quite clear that if those leases are not forthcoming, I think we can expect a small uptick in the cost of debt. So we're pushing like hell to make sure that those leases that we've been referring to in terms of the bulk leases come through to obviously reduce our cost of debt. You would have seen a slide earlier when Chanel was presenting that historically we had average cost of debt of about 8.8%. It's tipped up to about 9.2%, which obviously is on the high end where we would like to be. I think you would have seen from the numerous results presentations that shareholders would have probably seen from our peers. I think the property sector is going into some headwinds, and we are not immune to that. And I think we are anticipating that going into 2019, I think even with the long-term leases, we will still come under pressure, particularly on the escalation. I think a bone of contention, which was also raised at last week Thursday, is the apportionment of the rates and taxes, which government historically have not wanted to pay. That obviously adds a cost. You'll see, if you look at the rental that Standard Bank Greyville was paying at 60 Rand, with what we're getting from government. It's not that we basically charge a higher rental to government. It's because obviously private sector clients do cover their own rates and taxes. So I think we need to have a more transparent and a frank discussion with our partners from a leasing perspective in terms of what constitutes part of the lease and what doesn't. And clearly we as landlord are also proud of our buildings, and I think it's important that we have functional and healthy compliant buildings. I think if you go back to just page 25 there, we still believe in the sovereign strategy. We believe that once government basically gets their act together in terms of committing on the long-term leases, clearly they are paying. For me, there's no reason why they continue to pay higher rental on the short-term leases rather than not and getting the savings on the long-term leases. For me, I think we are quite clear that if they basically offer the 10-year leases, 7-year leases, we'll definitely gladly come to the party. I think in the proposal that we have given on the 227,000 square meters, we basically have proposed I think a 20% revision, was it? Is it slightly less? Yeah. Okay. But so I think we basically have given them quite a big incentive to sign long-term leases so that it gives a lot more certainty to the business. With regards to our sovereign, you will see that where we're actually taking a big hit is where we've deviated from our strategy, particularly on our industrial assets, where our vacancies are obviously a bit bigger. And obviously nodes like Sunning Hill, ordinarily we wouldn't be invested in a node like Sunning Hill. The only reason why we were there was because Eskom historically used to rent there. But our key node is the central business districts. That's where ultimately we would like to be. And I'm of the firm belief that once we get our balance sheet sorted out, we can put in major capex into our buildings, and we can basically set the benchmark above our peers and attract more tenants from our tenants. I think thank you very much for listening to that long presentation, but we've tried to be as transparent as possible. Again, we do offer any questions, if there are any, from the audience or from the webcast. Otherwise, myself and the management team are available outside. We are going on roadshow as of today, so we'll obviously engage further if people are not comfortable to ask questions in a public environment. Thanks. Is there any questions, Mane? Nothing. Okay. Anyone from the room? Chris, are you all right? Okay, thank you. Thank you very much, guys.